Hello guys, in this video I'm going to be talking about trades filter, which is a pretty cool thing to use with the order flow. And what it does is that the trades filter only shows trades which are bigger than a certain number. So if you look at the chart in here, then you can see standard candles. And on the left and right side of the candles, there is the bid and the ask. And if I didn't use the trades filter, there would be numbers on bid and on ask. But because I filtered out all the smaller trades with the filter, now only the biggest trades remain on the chart and we can see them. So this way we can see the biggest trades. The big guys, we can see where they placed their big trading orders. So the trade filter is great for tracking the big guys, the trading institutions. And as you can see in here on this chart, there were 3 places where the institutions, the big guys, placed a big order. In here, the 26 on bid, this 27 on ask, and this 28 contracts on bid. Now obviously the big guys use way bigger trading positions than that, but what they do is they do iceberg orders, which means they enter, for example, one contract, then one contract, and the algorithm does that for them. So they do this real quick, extremely quick. So we can't see them with the trades filter because they look like a small player, right? But if there's somebody really big who really wants to get in the market, who really wants to get in fast, then they don't use the iceberg, or they do it only partially, and they are forced to use bigger order. And we can see those bigger orders in here with the trades filter. Now you don't really need to set up the order flow, I did it for you. There is a template which I created. You just use it and your order flow chart will turn into this. It will filter out the trades, it will show the candles, and it will show only the biggest trades like this. It will also highlight those zones which are support and resistance zones. I'll talk more about this later in this presentation. Template will do also that, but there's one thing which you'll probably need to change if you want to trade some other trading instruments than currencies. And this thing, you can find it in indicator settings, and in here you can change the trade size, the minimal trade size it will show. So if this number is 25, then it will show all the trades which were bigger than 25 contracts. So in here there's 26. If this was 24, then it would show as a 0. If this was 24, it would show as a 0. Alright? So for currency futures, I use the trade filter 25. But if you trade other trading instruments, you'll need to change this number. Adjust it to the instrument which you want to trade. Alright, now it doesn't really matter if this number gets created on bid or on ask. Those levels create strong support and resistance zones, and because there's no telling the order was market order or limit order, it's just best probably to not make a difference between number which is on bid or on ask. This will be a bit more clear when I go to some trading examples. But let me now talk a bit about trading strategy, which you can base on the trades filter. First thing you want to do is you wait for a big trade on the filter. Like in here, there was the big trade, the 26 contracts, and then you watch where the price goes from there. So from this place, the price went downwards. And this could mean that there were strong sellers entering their selling positions to participate or maybe to initiate this selling activity. Now there is a condition. At least one whole candle needs to be above or below this number. So in this case, this is the candle where the number got formed. This is the 26, the big number. And this is the first candle which is below this 26. Alright, so in here, as this candle formed, this condition was met. Alright. Then also those candles were below this number. Alright. But you only need only one candle below or above. Now, what you do next is you wait for a pullback. You wait for the price to make it back to the price level where the number got created. Now the indicator will print this zone automatically, and from that place you want to enter a trade which was in the direction of the activity after the big number got created, the big trade got created. So in this case, there was a selling activity after those 26 contracts got traded. So when the price hits this price level again, you will go short. Alright, this is short trade scenario. If the price went upwards from the 26, like this, then you would be waiting for a pullback and you would go long. Now you can enter your trade with a confirmation or also without a confirmation. I'll talk about this a little bit more in the next slide. Now, this is important thing. If the highlighted color is red, or if the number is red, which is a number on bid, it doesn't mean that you would go short. The big number in this case could, for example, be in here, and still the price would go downwards from it. And still, even though the number was printed in green, like in here, still you would go short. Alright, so red doesn't mean short, and also green doesn't mean a long. Now you can use this as a standalone strategy. You can also use it as a confirmation strategy. I personally prefer to use the confirmation strategy. If you use it like a standalone strategy, sometimes the strike rate will be extremely high, but sometimes it will be not so good. So it won't be as consistent as if you use it as a confirmation strategy with, for example, volume profile, or with VWAP or price action, or other order flow strategy like the volume cluster strategy, multiple nodes, or with the imbalances. It's always best to look at more strategies, to have, for example, more order flow windows opened on your screen, and not only follow single trading signals, but always look at the bigger picture and on confluences. Alright, so that's why I prefer to use it as a confirmation strategy. It will be more consistent than if you used it as a standalone strategy. But as I said, standalone strategy is also okay to trade. It is not a holy grail, but it's nice and working intraday trading strategy. Now, I use this strategy with 30-minute time frame, but you can go into faster time frames, and you can use 15-minute or 5-minute time frame. I wouldn't really go higher than, for example, 1 hour time frame, because still this is order flow, and it's most suited for intraday trading. Right? Those time frames are, in my experience, the best ones to use with this strategy. What you can do if you want more trades, if you're a scalper, you can go for the 5-minute strategy, 5-minute time frame, and you can set the trade filter to lower numbers, so not 25, but for example to 15 or 20, and with this you'll get way more trading signals, and you can trade them on the 5-minute chart. But the way how I do it is I use the filter with minimum trade size 25, and I use it on a 30-minute time frame. That's for major currencies. If you want to trade other trading instruments, you will need to set this number depending on how many signals you want to have. Remember, you always want to filter out the smaller trades, so you don't want to have too many numbers in every candle. They will just give you too many signals and a lot of them would be false. So you want to only see the biggest trades, alright? Now that's for the theory. Let's now have a look at some trading examples of this trading strategy. This is a Australian dollar currency futures 30-minute chart, and as you can see, there were 29 contracts traded in here on bid. The price went upwards, then from that place it went downwards, so there was a rejection, and some strong sellers entered the market in here with this huge order. Now let me repeat what I already said. It doesn't mean they entered with 29 contracts. What they could have done is enter with the iceberg order. So they, for example, entered 29 contracts, then they entered 10, then 20, and so on. And all this could happen, for example, within 1 or 5 minutes, all right? But we only see this number because of the trades filter. Alright, so the big guys were entering the market in here and they pushed the price downwards. There is a whole candle below this number, below this resistance zone. So you wait for a pullback, and when the price hits this level again, you can enter a short from there. You can wait for some sort of confirmation on order flow. I would look at a bid and ask on a 5-minute chart to see some confirmation, and then I would go short, or you can enter the trade without a confirmation. So when the price hits this resistance, you go short. Alright, so let's have a look at another example. Now in here you don't have this line printed, because this line gets printed only until it gets tested, but it didn't really get tested in here. There was a selling activity, then the price turned, and the price went upwards. What turned it is those guys in here, 32 contracts. This is the zone. This is the support zone. It's not printed because of this candle, but this is just a technical issue. The support still wasn't tested. This was the rejection, then the price went above it. This was the pullback, and this is the place for your long. Alright, as you can see, number is red. The order was created on bid, and still we go long, because this number was most likely a limit order, a buying limit order. And as I said in one of the first videos, a buying limit order shows on bid. Alright, in here. So that's why I think this was a big player, big institutional player entering with a buying limit order, finally turning the price into a buying activity. When there is a pullback, there's a big chance that this big guy, this institution, will try to defend this area, to defend their position, and to push the price upwards. Alright, so long from there. Next trading example. Price went upwards, then it turned into selling activity, and right here, almost at the top, 28 contracts on the ask. And this would probably mean that those 28 contracts was a limit order for a sell, because a selling limit order shows on ask. I also said that in the video I was referring to a few moments ago, alright? So that's why it is green, that's why it could look for somebody like a buying order, but most likely this was not a buying order, most likely this was a selling limit order. So one candle formed below it, this was the pullback, this is the resistance, this is where you go short from. Another example on the Australian dollar futures, again 30-minute chart, price was moving upwards in an uptrend, and within this uptrend there were big guys entering their buying positions. In here, also in here, this is the support. So as the price was advancing upwards, those guys wanted to add to their buying positions or enter their buying positions in here. Then one candle formed above this area, this one, and then there was the pullback which hit this support level and the price went upwards again. Those buyers were defending their buying positions and they pushed the price upwards. Another example on the Australian dollar, there was volume accumulation area, the price was rotating, volumes got accumulated, as you can see also on the volume profile. Then the price shot upwards and those guys who entered their 31 contracts in here were defending their buying positions when the price hit this level again. This is the reaction. Those guys were defending their buying positions, alright? Now you can also notice this 30 contracts on the bid side, and I would say that this was most likely a limit order to enter a buy. So this was probably a limit order, limit buying order, and this was market buying order, alright? Both those buyers, only those guys entered with a limit order, those guys entered with more aggressive market order, probably to start this trend. Alright, so strong buyers, and when the price made a pullback, they were defending their buying positions and they pushed the price upwards from this area again. Now one more thing to notice, those 27 contracts at the top of this candle. This could mean buyers quickly and aggressively quitting their selling positions with the market order. And as you can see, this area got tested in here. The price did not quite reach the area, it missed by one tick, but this area worked also as a resistance, and then there was a reaction to it. Now another example shows really strong buying activity in here. Most likely buyers entering with market orders, those guys, those guys, those guys, and this area is a support. This whole area is a support. The program didn't print it because this green candle got in a way, it sort of tested it, so the program didn't print it, but the support is still not tested, and as you can see, the price went above it, then slowly returned back, and then you go long from there. This is the reaction you want to see. Again, you may want to wait for a confirmation somewhere around this support zone, or you can just enter with a limit order at first touch. Now you've probably also noticed that there was support in here. It would be a long from there, but in this case the strategy would fail. This one would be a losing trade. The reaction to the buyers came later. Market reacted to those buyers, but not to those buyers. Alright, so next example. Also the futures for the Australian dollar. Price was going downwards, and there was a big market order as the price was progressing downwards. Somebody was entering their selling positions quickly in this downtrend in here, 27 contracts on bid. So that's market selling order most likely. And when the price hit this resistance level again, those big guys were defending their selling position and they were pushing the price downwards. So this is the reaction you want to see. Now there's also a reaction to some old support from here. This is the reaction. And also there is this support which got tested. Let me delete all that. So this is the support. Buyers were pushing the price upwards. In here they were entering with market orders. This is probably a limit order, but it doesn't really matter. If it was limit or market order, this was a support. Price went above it, returned back with a pullback and long from there. If in the future the price hit this support, the lower one, it would also be along from there. Alright. Now another example. There was a rejection of lower prices, and within that rejection there were buyers entering their positions in here and in here. As you can see, there were 80 contracts. That's a huge number. Now after that rejection we have two supports. First in here, second is in here. The price made a pullback. Those buyers were defending their buying positions. They pushed the price upwards from there. And also those buyers from here were also defending their positions. I would say partly in here, but also partly in here. If I was trading that, I would probably taken only the first trade, this one, and when I saw this reaction, I would discard the lower trade, because it would seem like this support got already tested. Alright, there is also one more in here, those 38 contracts. There was this rejection of higher prices, and those guys probably placing a seller limit order. That's why they show on bid. There is one candle below that, and there is a pullback to this zone, which in this case is a resistance, and you go short from there. Now another example, this is a rejection of higher prices, aggressive rejection, and in that rejection 26 contracts. By the way, this is 6E, which is Euro futures. So this is the rejection, 26 contracts within the rejection. This looks like a market order, selling market order. It seems like the sellers wanted to aggressively turn the price downwards. That's why they used the aggressive selling order in here. So they pushed the price downwards, created this resistance. Then there's the pullback, and this is the reaction. Those sellers defending their selling positions. Now there were also aggressive sellers in here, 48 contracts, and those were created in this downtrend, in this selling activity. So somebody was quickly entering their shorts in here to jump into this selling activity, to participate in it. So this level turned into a strong resistance. Those sellers should defend it. There was a pullback, several candles created below that level, and this was the reaction. This was the sellers defending their selling positions in here. Alright, so in this screen, two possible short levels. This is first one. This is the second one. This is a crazy volatility on euro, strong selling activity, really strong sell-off, aggressive sellers entering in here, 25 contracts on bid. This is most likely market order, market selling order. This is a resistance. The price went below that level, was rotating below it, then there was the pullback, and in here that was the reaction to the resistance. Those sellers trying to defend their selling positions, creating this selling activity in here. That's around 17 pips, more than enough to bank a profit. Now another trading example, this one is on the Japanese yen futures. The price went upwards and then it aggressively turned, made a rejection of higher prices and went downwards. Within that rejection, 66 contracts created in here. This is most likely a market order, market selling order. Sellers entering the market aggressively in here at this price level. So this is a resistance, price is rotating below it. Then there is the pullback in here and short from there. Those sellers rejecting higher prices again, defending their selling positions and pushing the price into a sell-off. In here there is a similar scenario, only reversed. It is also on the Japanese yen futures. There was a rejection of lower prices, 32 contracts traded on the ask side of the candle, and this most likely means aggressive buyers entering the market with buying market orders, turning the price upwards. So when there is a pullback, this level is a support. Those guys are defending their buying positions and pushing the price upwards from that support. Alright, so let's have a look at another example. In here, this is also the Japanese yen futures. There are two filtered trades, this one and this one in this area. The price goes upwards from this area, and this indicates that those guys were buyers, and because they placed their orders on the bid side, they entered, if they are buyers, they entered with their limit orders, which makes sense because when there is a rotation, they didn't need to hurry anywhere. They waited until the price hit their waiting limit orders. So that's how I think they entered their trades in here. Those would both be supports, this and this. But since the price already reacted to the first one, I wouldn't really advise you to trade the second one, because it could be that this was one trading institution. We'll never be able to tell, but anyways, this support seems to be spent with this huge reaction. Now this is a last example. Australian dollar futures. There was sort of uptrend in here. Within that uptrend, 27 contracts on bid. If this was buyers, then it would mean that those buyers entered with a limit order. And this big order of theirs means a support. So there was a rejection of higher prices. Price went into a pullback to this area, reacted to those heavy volumes in here, and the price went upwards from there. Alright, so that's how you use the trades filter. I like to use those big numbers in a trend or in a rejection, as you already saw. It's always good to think of what happened in the market, whether it's a market order or a limit order, but you don't really need to do that all the time. You can just trade this blindly and just follow those highlighted zones. Those will point you to strong support and resistance zones. Alright, so that's for this video. Thanks for watching, and I'll see you in the next one.